Welcome to Accounting with Audra. In this second video in a multi-part series on accounting for bonds, I'm going to talk about how to account for bonds sold at a premium from a company perspective. We'll again do a present value computation, talk through the journal entries for the issuance, the interest payments, and the settlement of the bond, as well as do an amortization. If you're looking for more information regarding, in general, why something is sold at a premium or discount, please refer to the first video where I discuss bonds at a discount and overarching concept of bonds in general. So looking at bonds sold at a premium, we're going to just jump right into an example. This time I'm going to do a 5-year $600,000 bond, so similar to what we did in the discount example, except we're going to do interest paid annually so you can get a sense of how to do interest computations not every 6 months, but instead one time a year. Stated interest rate for this bond, so what was put on the coupon is 5%, and the market interest rate at the time these bonds were sold, the $600,000 bond, is 3%. So in this instance, we've got stated rate at 5, which is greater than our market interest rate of 3. So these bonds have a very attractive interest rate, and because of that, they're going to sell at a premium because they offer more than what other similar investments would offer in the market. So looking at our bond example, the first thing we have to figure out is how to record our bond. And the price of a bond first starts with the present value of the maturity amount, in our case $600,000, and then we add to that the present value of the stated interest payments. In order to do the present value of both items, we need our present value tables. So we have here a present value of a dollar table and the present value of an annuity table. And we need to look at our factors. In this case, we have a 5-year bond, interest paid annually. So the number of interest payments will be 5, and our interest rate we want to use for purposes of doing our present value is the market interest rate. So here we would use the interest rate of 3. So using the present value of a dollar to determine our maturity amount, it's 0.863. And looking at the present value of an annuity table, we would use 4.58. So that's what we'll refer to as we do the math for our present values. Okay, so present value to maturity amount, we want to use our present value of a dollar because we're looking at what that amount is today versus 5 years from now. Again, these amounts are rounded in my present value table. They go out a few more decimal places. So if you're on a calculator and you don't exactly get to my number, no, it's just rounding. But 600,000 times 0.863 is 517,565. To do our present value of our stated interest payments, first we have to figure out what those stated interest payments are. So we're going to take our interest of 5%, which is the stated interest rate, the coupon rate, times our maturity amount or our bond amount of 600,000, and that gives us a $30,000 interest payment that is going to be made annually. Since we're looking at what the present value of this is, and we're looking at 5 $30,000 payments, we want to use our present value of annuity factor. So 30,000 times the present value of annuity of 4.580 gets us 137,391. If we add those two amounts together, we get to a total price of the bond of $654,956. Another quick sanity check on bonds is since we know this bond is selling at a premium, if we've done our math right, the sum of the two numbers should always be more than the stated value or the maturity value of the bond, in this case, the 600,000. So if it was less than when you do the math and you know this is a premium, you know you did something wrong. So just a quick check there. So another way to look at this is that essentially the investor will invest $654,956. That's the price of the bond we just determined based on the market rate on the date of purchase. And in return, they're going to get $30,000 of interest each year and $600,000 at the end of the bond term of 5 years. So they'll get $150,000 of interest plus that amount. So they'll invest $654,000 and they'll get $750,000. Let's go ahead and journalize this bond at issuance for the company who has issued them. Initially, the company will get cash from the investor of $654,956 based on the purchase price. The bond payable is always credited at that face or maturity value at the end of the day that is going to be settled. So in this case, we'll credit the bond payable for $600,000. The difference between the cash amount and the payable is generally our discount or premium. Now we know this one is selling at a premium, but If your plug is a credit in this instance at issuance, that's another way to know that this is a premium on your bond payable. So the difference to balance out our debits equaling our credits is $54,956. Then, as we make each payment, we are going to debit interest expense. We always debit interest expense, and that is the balance. So in this case, that's going to be the $654,956 times our market interest rate, that is 3%. Our cash will be that stated interest payment that we just determined of $30,000. And then the difference between those two will always be a plug. If we're dealing with a premium, we know the plug is going to be a debit, essentially the opposite of what we initially journalized on issuance, because we're going to get that premium down to zero at the end of the day if we've done everything correctly. So just walking through the math here with the interest expense in our case, if our balance is $654,956 and our market interest rate is 3% or our effective interest rate, those are the same terms, then my interest expense is $19,649. The cash we already determined, it's constant, $30,000. And then the difference between those is our plug. In this case, we know it should be a debit, and it is. That's good when the math works, for $10,351. And that is our first journal entry at the end of year one for purposes of both the payout as well as recording interest expense by the company that issued the bond. Those payments will be the same from a debit credit standpoint every single year, just the values are going to change a little bit as we move through the effective rate and the value of that bond comes down closer and closer to $600,000. How can we prove our numbers are right? We can always do an amortization schedule to lay everything out. Our amortization schedule generally starts with your payment and your date, stated interest, effective interest, premium, and your balance. So in the beginning, we go ahead and put what we initially computed as our balance and our premium. That's what we want to start with when we're doing our amortization table. On the first payment at the end of the year, so assuming that this was issued on 1/1/2021, we will have an interest payment of $30,000. Our effective interest, again, is that balance times our effective interest rate, 3%. So that gives us the $19,649 we just computed in our journal entry. And the plug is the difference between what I have as a stated amount and that effective amount. And my balance also adjusts by that difference. So whereas in a discount, your balance went up to $600,000, on a premium, what's going to happen is that adjustment to the premium is going to bring our balance down. So our balance is going to reduce by $10,351. In year 2s, 3s, 4s, and 5s, I'm going to make very similar adjustments. So let's do another one. In the second payment, I'm going to take my new balance, so $644,605 times my 3%. That's going to give me $19,338. The difference between the two, my plug will be $10,662, and my balance will be $633,943. So I'm slowly moving down to my maturity amount. This would be a great time to pause this video if you're trying to work through this. Build yourself an amortization table out and see what answers you get. And what I'll go ahead and do is move forward and give you the rest of the payments. So moving forward for the rest of this schedule, once you've completed it, this is what you should end up with from an amortization table. So if you are trying to follow along and you did pause, hopefully you've come back and you tied to this. Again, rounding might have you off by $1 or so, but that's okay. And essentially, we want to get to that $600,000. That's how we know we've done all of our numbers right. We've used the right present value factors and everything if we've done this right. And that gets us to our final balance. And then we have our 5 interest payments at $30,000 a piece. So again, this just also validates that the investor paid $654,956, our beginning balance. And at the end of the day, they receive that $600,000 plus 5 interest payments at $30,000 a piece, or $150,000 for a total of $750,000. Let's go ahead and do some more journal entries now that we have our amortization table complete. So looking at year 2, our journal entry here would be a debit to interest expense, $19,338. Our cash would be our $30,000 constant, and our debit to premium on bond payable would be a plug of $10,662. The last journal entry, so I'm going to skip through years 3 and 4 and go straight to year 5, will debit interest expense again for what we've computed in the last year, because we need to do our last coupon payment before we close out this bond. We'll credit our cash for $30,000, and our plug should tie to what we've recorded on the amortization table for $11,650. And then all the company does is debits the bond payable and credits cash at the end of the day to get rid of the loan when they have returned the investment to the investor. Some additional considerations with respect to premiums. If a company chooses straight line method, just like on a discount, all you really do is you take the total premium, divide it by a number of payments, in this case 5, and you make exactly the same journal entry every single payment. So you don't have a variation in your interest expense and your plug, you just make the same payment. Again, you can do this method if it does not have a material impact on your financial statements. Another thing a lot of times people ask is, what is more favorable, purchasing a bond at a discount or at a premium? The truth of the matter is it depends. It all comes down to, what did you invest? What was the final payout on that bond? And how much interest or stated cash payments did you get over the life of the bond? So it's really a mathematical question. A lot of times companies try to issue bonds if they can at a discount because everyone likes a deal in a sale, but it doesn't always work out that way. But it doesn't mean you're not getting a great deal, even if you're buying a bond at the premium. You just have to look at what the initial investment is and the end of the day payout was. As always, if you like these videos, please consider subscribing to receive updates when new videos are posted. And also feel free to put comments in the chat below or provide some input on videos you would like published to help you with your everyday accounting needs.